This is how we do it.
So Warren owns several stocks, and we're going to find out if any are at a value right now. And we're going to put some of those on your radar, give you a few fun facts, but always remember at the end of the day, before you hit that buy or sell button, it's your money and it is your responsibility. Hey, what's up? I'm Russ, and this is Dapper Dividends. Thank you for making me a part of your investing journey. And if you have a beating heart, give this a big ol' thumbs up. And always remember that my opinion may change based on new information, but as we need to do as good little boys and girls that are investors, we need to make the best educated guesses that we can with the information available to us right now. Oh, and check that out. I think I'm going to start doing this. Now, I love philosophy. I love motivational things. I love so many things, but I think just for the sake of where this is going to go, that I'm going to put the current portfolio value of the bridge portfolio. This is the portfolio, as those of you who follow the channel know, but welcome to those of you that are new. I started building this around September of 2018. That's when I first diligently started to really become a dividend growth investor. So check that out. We're pushing $60,000 current value and already over $2,100 in dividend income projected for the next 12 months. They also call that PADI, projected annual dividend income, which I think I might start writing that instead of the next 12 months. So look for big changes on the horizon. All right, let's say bon voyage and get this video underway. Warren Buffett is a long-term value investor, meaning that he's simply trying to buy stocks that he thinks are undervalued by the market. And growth stocks are pretty much at the opposite end of the spectrum, where investors think those are going to have outsized earnings potential, and they're going to give better than average returns. Now, a lot of people say that there's a shift underway from growth to value. So this is something I like to use, handy tool. You can go to morningstar.com, click on the markets tab, and in there you'll find this US market barometer. And check that out. 3 years ago, growth in the last 3 years, growth has been at 22.8 and value at 5.02. So down the board, growth has outpaced value. The 1 year growth 27, value at 25 for the large caps. And that just goes to show you, check it out, 22, 5, 27, 20 in the last year. So it just goes to show you that money's starting to rotate into the value side. And this could be a shift that's going to stick with us for years to come. And the 1 day is 1 day, but still, look at that. Out of the last 1 day, growth has been underpacing value. Now, the bulk of this data was taken from a combination of insider monkey articles and information off of sites like Ticker, where they show us the 13F filings. Now, 13F filings are what asset managers who have over $100 million under management have to file every quarter, a 13F. So you can come to a site like tikr.com, and they have investing gurus. Click on investing gurus, and there you'll see under the first column is the likes of Berkshire Hathaway. You'll see all the information from their latest 13F filing, and you can sort by percentage of shares outstanding and go down the line, and you can see exactly what they're holding, what it is as a percentage of their portfolios. And it's just a wonderful site that you may not have been aware of. So have fun with Ticker, tikr.com. Now, one thing I do want to caution you about with 13F filings, which is what all the big hedge funds use, is that it's a snapshot of what they held on the day that they filed. Don't just go all in. It's a great tool for investing ideas and to put things on your radar, which is what we're going to do here. But just know that by the time we get this information, these hedge funds could have completely blown out of some of the positions and some of the holdings listed. So always take it with a grain of salt. Do your own due diligence and make sure that what you buy fits the game that you're playing. So there's a link to the article below that Insider Monkey has that a lot of this information came from, which you can check out for yourself. And it was about the 11 value stocks that Warren Buffett owns that may currently be a buy. So 9 of those 11 pay a dividend. So that's the ones we're going to focus on. And it all starts off with number 9, which at 0.01% of the Berkshire portfolio and coming in at 675,000 shares held. Wells Fargo and Company, ticker WFC, is an American multinational financial services company founded in 1852. And I think they might be older than Warren Buffett. Their current PE of 12.13 is about 42.45% below their 5-year average. They have a current dividend yield of 1.77%, a very low payout ratio of 17.58%, and they pay that out quarterly, 20 cents a share. In August of 2020, they cut that dividend from 51 cents to 10 cents, and they just recently raised it to 20 cents a share. Number 8, also at 0.1% and owning 578,000 shares, is Mondelez International, ticker MDLZ. They are an American multinational confectionery, beverage, and snack food company, and they split from Kraft Foods in October of 2012. Oh, and did you know they have 18 factories around the world cranking out 40 billion Oreo cookies a year? And if stacked together, that would circle the earth 5 times. They have a current PE of 20.07, meaning you're paying $20.07 for every $1 of Mondelez earnings, which is about 26.91% below their 5-year average. Decent dividend yield at 2.31%, very low payout ratio of 48.27%, 5-year growth rate of 13%, and they do pay that $1.40 dividend out quarterly at 35 cents a share. Number 7 at 0.1% as well, and owning 315,000 shares, the Procter Gamble Company, ticker symbol PG, is an American consumer goods corporation founded in 1837. And about 1850, the original logo of Procter & Gamble was a man overlooking 13 stars to represent the 13 colonies, but was changed in 1985 after they were under attack from the Satanic Panic. Interestingly enough, I lived through this, and I was in church at the time this was going on, and they taught us that Procter & Gamble was a front for the devil. And even to this day, it kind of crosses my mind. It gives me pause to buy Procter & Gamble, but I've looked into it, I've vetted them, and no, they are not working for the Prince of Darkness. They have a current PE of 26.19, which is about 22.27% below the 5-year average, which is just fantastic for this big blue chipper. That dividend yield is at 2.42%, paying out $3.48 annually. Not a terrible payout ratio at 58%. A very low 5-year growth rate of 4.5%, but they have been growing that dividend for 65 years. And check it out, they have had 131 years of dividend payments. And number 6 at 0.1% as well, and owning 327,000 shares, is Johnson & Johnson, ticker JNJ. They engage in the research and development, manufacture, and sale of products in the healthcare field. And the reason I love them so very much is they operate through 3 segments: consumer health, pharmaceutical, and medical devices. Oh, and did you know their logo is the handwritten signature of Robert Wood Johnson that has been used since their founding 135 years ago? So J&J's 5-year average P is at 82.65, but this is because of a $13.6 billion tax hit from a new law that was passed in 2018 where U.S. multinationals, they could bring back their cash from foreign operations at a reduced tax rate. So J&J took a $13.6 billion charge, and that obviously dropped their earnings, which shot up their PE, but that was a one-time exceptional item only. So if we remove that one-time exceptional item and I kind of average out the PE for those 5 years, I get about 22. So the current PE of 24.26 is about 10.27% over the 5-year average, which their current dividend yield is 2.65%, paying out $4.24 annually, a very low payout ratio of almost 44%, a respectable 5.96% 5-year compound annual growth rate, and they have been growing that dividend for 59 years. Now, basically what we're looking at, just going off the 5-year PE average, you're paying about 10% premium for Johnson & Johnson right now, which I am okay with because they are one of the strongest and best blue chip dividend paying companies that I think every serious dividend growth investor needs to have as a part of their portfolio. Number 5 at 1.26% of the Berkshire portfolio with 72.3 million shares. The Bank of New York Mellon Corporation, ticker BK, is commonly known as BNY Mellon, and they are an American investment banking services company with more than $41.7 trillion of assets under custody. Their current PE is 14.78, making them about 18.27% over the 5-year PE average. They have a current dividend yield of 2.4%, paying out $1.36 annually, really low payout ratio, a whopping 12.65% 5-year growth rate, growing the dividend for 11 years. That dividend was frozen at 31 cents during the pandemic of 2020. But since 2013, they have had a compound annual growth rate of 10.77%. Number 4 at 2.5% of Berkshire's portfolio with 129 million shares is US Bancorp, ticker USB, which is an American bank holding company and the parent company of US Bank, and is the 5th largest banking institution in the United States. And they have nearly 70,000 employees in 13 countries. Their current PE is at 12.08, which makes them about 12.69% under the 5-year average. Current yield of 3.06% with a low payout ratio of 36.40%, 5-year growth rate of 10.48%. They have been growing that dividend for 11 years. So yeah, US Bancorp is about 12% under the 5-year PE, but not a really big dividend. And I think if I had to choose so far out of the banks on this list, even though I don't own any, I would have to go with Wells Fargo. The threes are wild. We've got number 3 at 3.03% of Berkshire's portfolio at 158.8 million shares is the one, the only Verizon Communications Incorporated, ticker VZ, is an American multinational telecommunications conglomerate and is the largest U.S. wireless provider with 121.3 million subscribers, and they have invested $159 billion in their network since the year 2000. Their current PE is at 10.83%, which is about 11.88% under the 5-year average. That yield has really shot up since the telecoms have been falling, currently at 4.93%, paying out $2.56 annually. Low payout ratio of 48%, not a lot of growth in that dividend of 2%, and it has not been growing for 8 years. It has been growing for 15 years, and I know this because we just did a video on Verizon. Now, when you're buying a company like Verizon or AT&T, we're not buying it for the growth. There's not going to be a lot of growth. They're just a big, mature company that's building an ever-increasing moat, and we're buying that for the dividend income, for the passive income, because that's what's going to attract investors and keep investors holding in the stock. Number 2 at 4.53% of the Berkshire portfolio, and with 325.6 million shares is the Kraft Heinz company, ticker KHC. They're an American food company that was formed by the merger of Kraft Foods and Heinz in 2015 after Heinz owners 3G Capital and Warren Buffett's Berkshire Hathaway teamed up. Their current PE of 20.89 is about 35% below the 5-year average. Very nice starting dividend yield of 4.29%, paying out $1.60 annually. We'll get to that 5-year growth in just a second, and that's paid out as 40 cents per share every quarter. So in March of 2019, the dividend was cut 36% from 62.5 cents all the way down to 40 cents, where it's been frozen ever since. But the trailing 12-month free cash flow payout ratio is only 49.3%. So if you're okay with that frozen divvy, they don't have any problem paying it as things are right now. I think you could do worse than Kraft Heinz, and especially if you're a fan of some of their brands, it might be something you'd like to add to your portfolio. And number one, at 14.21% of Berkshire's portfolio, with an astounding 1.2 billion shares, is the Bank of America Corporation, ticker BAC, which is an American multinational investment bank and financial services company. Hey, did you know that Bank of America funded Charlie Chaplin's The Kid in 1919? Snow White and the Seven Dwarfs in 1938, and they also funded Disneyland in California in the 1950s. Bank of America's current PE is 13.89%, which is about 1.17%, just below the 5-year average. Dividend yield 1.86%, paying out 84 cents annually. Low payout ratio of 25%. A whopping 5-year growth rate of 27.23%. They've been growing that dividend for 8 years. So that 27% 5-year compound annual growth rate is really nice, but the dividend is not even 2%, so it's not even going to be pacing inflation right now. Let me know in the comments below what you think of these companies. Which ones do you hold? Which ones do you hate? Which ones might you pick up? We'd love to know it. And if you'd like to know more about Verizon, which I think is a hot dividend buy, check out the video right here, and I will see you there.